Hey guys, it's Keenan Starks here with your local real estate market update. This is your source of education and information on things that's going on in the real estate market. The world today, I know you guys have seen the news and OMG, what's going on in the world today. But I'm not going to get too much into that. I'm going to get straight into the news and what's going on in the real estate market to keep you guys informed. So let's get straight into it. So let's look at the Housing Market Recovery Index. This is just a graph that puts everything into perspective with the housing market and what's going on with the supply, demand, price, and time on the market. We can see here in February, before everything went bad, that we were on the uptick, and then now all the way here at the end of November, we can see that we're back on the curve to recovery, and we've actually recovered from the V, and we've kind of settled into a nice market to where we're kind of right now. It's the winter season, so things kind of slow down customarily around this time of the season, but you can see that we settled into a nice market to where we're kind of on the uptick here. So I'm going to keep an eye on that. I'll keep you guys informed on what's going on with the recovery. Let's hop into what's happening here locally in the Twin Cities with these numbers. We can see here that according to Minnesota area of realtors, that our new listings are actually up 1.5% from this time last year. Closed sales are up 18.6% from this time last year. Average sales price is up 11.5% from this time last year. Percentage of original list price is still at around 100% and even a little bit higher from this time last year, 2.7%. The price per square foot is up. We can see that's around 7% higher. Inventory of homes for sale, which is the big issue that we're having right now across the nation. Here in the Twin Cities, our inventory of home for sales are down 37.6%, which is crazy right now. Month supply of inventory is about 1.2 months, which is down 42%. And right now, what that means is that if sales kept going the way that they are, we would be out of homes for sale in the entire market in a little bit over a month, 1.2 months. So right now we're in a heavy seller's market right now. And if we hop back into what's happening nationally, we're going to go into what the experts are saying. At Move.com, they're saying buyers and sellers quickly jumped back into the market this week after taking a break during the election week, according to Realtors.com weekly housing report for the week ending in November 14th. So that's what Move.com is saying. If we look at what's happening in forbearances from the height of the crisis to what's happening now, we can see that foreclosures are decreasing dramatically. So that's a good thing. If we look at what happened to everybody that took out, or everyone that received the forbearance, we can see at this graph here of what happened when that forbearance period expired, or what's happening now. What's currently happening with everybody that took out forbearances. So right now with this graph, what it's saying is that out of everyone that took out forbearances, 54.6% of those people either paid the loan off in full or paid their past due payments up in full. 30% are still working out a payment or still on a repayment plan or working some type of modification to get their back payments or whatever they missed back current. 14% are still in trouble. So that 14% of people may be in some type of mitigation plan or some type of short sale or something that they may have not been able to recover from their financial troubles. So what they're saying here is that out of everybody that applied, only 14% of those people may have serious trouble, and those properties may be looking to go into some type of sale, which may not guarantee a sale, but those people are most likely to have some type of sale. Even though there's a lot of things going on in the world right now, a lot of people may not know what their options are with the forbearances. So here are a couple of things that I can provide to you guys that if you are in some type of financial hardship, you should reach out to your financial lender or your financial institution and see what type of options you have. If you don't know that these, the CARES Acts are it's meant to protect homeowners with federally backed loans like FHA, VA, USDA, Fannie Mae, and Freddie Mac. But even if you don't have one of those providers, still reach out to your lender. Let them know your situation. Who knows? They may give you some type of relief. So a lot of people say, are the prices of the homes going up too fast? Is this going to be a housing bubble or, something similar to what happened before? So let's go to what the experts are saying. The managing director at the S&P Dow Jones, he says housing prices were notably, and I'm tempted to say very strong, with September. The National Composite Index, and if you guys don't know what the National Composite Index, the NCI, according to Investopedia, the Composite Index is a statistical tool that groups together many different equities, securities, and indexes in order to create a representation of the overall market or sector performance. So in this case, it's the real estate, and they say that the National Composite Index gained 7% relative to its levels a year ago. Our 3-month readings since June of its year have all shown accelerated growth in home pricing, and September's results are quite strong. So that's what the experts are saying at Dow Jones. So if we look back all the way to 1991 and what's happening with the compound annual housing prices, the appreciation has been consistently about 3.8% since 1991. But if we look back at 2012, we can see that there's been a consistent 6.1% year-over-year annual house price appreciation over time. So if we look at that into what that looks like on a graph of real time, we can go back to 2000 and see what that looks like on 3.8% appreciation of home sales or home prices over time, and we can see this consistent graph. And if we put into consideration of what actually happened and where we are today, we can see that the actual appreciation is actually exceeding historic appreciations as it did before in 2006. So we can see that's one reason how we can see into a visual form of what's actually happened with home appreciations. And if we ask ourselves, why is this happening? Why are things appreciating so fast? We can look at this graph and say, okay, well, if you look at this, we can see that as the supply of the inventory goes down, the prices of the homes go up, which is the economics 101, supply and demand. The less product that you have, the more demand you're going to have, so the more the prices go up. So let's turn to what the economists are saying. The chief economist at NAR, he says such a frenzy of activity reminiscent of 2006 raises questions about a bubble and the potential for a painful crash. The answer, there's no comparison. Back in 2006, dubious adjustable rate mortgages taxed many buyers' budgets. Such loans didn't even require income documentation. Today, buyers are taking out 30-year fixed rate mortgages. 13 years ago, there were 3.8 million homes listed for sale, and home builders were putting about 2 million new units out. Now inventory is only about 1.5 million homes, and home builders are underproducing relative to historical averages. So I like to talk about what experts are saying, just so you guys know that, this isn't my opinions. This is what experts are saying too. So that should give you an insight of, the experts' visions of what they're seeing is happening right now. So another headline that's been topping the charts is American mortgage debt that soared to $10 trillion this year, or 2020. At the end of the third quarter, the national mortgage debt was $85 billion in the third quarter. And at the end of the third quarter, it was $9.86 trillion. So that's a record high right there. And the Federal Reserve, they say this about the mortgage balances. They say mortgage balances, the largest component of household debt, rose by $85 billion in the third quarter and sat at $9.86 trillion on September 30th. Mortgage originations, which include refinances, were at $1.05 trillion, the second highest value in the history of the series and the second only to the historic refinance boom in 2003 quarter three. That's according to the Federal Reserve. They say that even today that the household debt service ratio for mortgages is at an all-time low at 3.72%. And what that is the total quarterly required mortgages divided by the totally quarterly disposable income. So that's today where we're sitting at about 3.72, and we can see during the housing bubble at the peak, it was at about 7.21% of the disposable income of the nation. So looking ahead into this crystal ball, which I wish I did have, but I don't. So I'm just going to go from what the experts are saying and what I'm seeing out there in the economy. So let's look ahead a little bit. What's coming up? The chief economist at Indeed, he says, above all, 2021 outlook hinges on the course of the coronavirus. Of course, both the recent virus surge and the elections make government emergency relief more likely. Next year will also start to show whether the two of the big pandemic shifts will endure. From services to goods, from in-office to remote work, from services to goods and from in-office to remote work, even small shifts in these trends, if permanent, could cause big changes in how businesses hire, how job seekers search, where people live, and how much they earn. So that's what the experts are saying. So let's look at what's happening with Freddie Mac and what their projections are for the interest rates. This graph here shows us that they're planning to stay really low, right there in the 3% range throughout 2021. That's according to Freddie Mac here. Also, the chief economist at Realtor.com, he says this: we expect home sales in 2021 to come in at 7% above 2020 levels, following a more normal season trend and building momentum through the spring and sustaining the pace into the second half of the year. While home sales are expected to lose some momentum over the last months of 2020, the shallower than normal seasonal slowdown creates a higher base of activity leading into 2021 that is roughly maintained for the first half of the year. As vaccines for the coronavirus become broadly available to the public and economic growth reflects the resumption of more normal patterns of consumer spending, home sales gain even more in the second half of the year. So what they're saying is that normally right around this time we have a slowdown, which gives us a basis for the next year, which we tend to overcome our low basis of this year. So this is right around the time where things slow down, but according to what's happening and what experts are saying, that we're going to expect 2021 to come in a little bit or 7% higher than what the sales did in 2020. If we look at the forecast of what home prices are going to do from the experts, we can see the CoreLogic here, the underliers are still at around 1.9%, and the highest is Zelman Associates, they're at 5.9%, which across the board I can say it's easily about a 3 to 4% across of what experts are seeing for the forecast of home prices. The chief economist at NAR, he says any foreclosures increases will likely be quickly absorbed by the market and it will not lead to any price declines. And what that's saying is that there's so many people out there looking for homes and so many investors looking for deals, I guess, that if any foreclosures did hit the market, it wouldn't make any much of a damage to what's going on out there with the home prices. So overall, we can say that housing has experienced that V-shaped recovery, with the housing market index from Realtor.com up 12% from February. We know the buyers are jumping back into the market in groups and heaves, and while the numbers of forbearances are decreasing all across the board, we know that the total of people that apply for forbearances, 14% of those are still in trouble. 54% of those people are paid out, are caught up with their payments, and 30% are still in some type of repayment plan or some type of deferral. We are currently exceeding the 3.8% historic home value appreciation, and the supplies of homes are at record lows. While mortgage debts hit record highs at $10 trillion, mortgage rates are predicted to stay really low in 2021, and sales are expected to increase 7% compared to 2020, while prices are expected to appreciate at about 3 to 4%. Experts are saying that any foreclosures that will hit the market, then they will quickly be absorbed by the market. So guys, I hope this video has helped you out. I realize that you may or may not be looking to buy, sell, or invest into real estate, but if you know somebody that is, please pass along my information. I would love to help them out and get the process started. See you later, guys. Enjoy, be safe out there, and Happy New Year's.